The arbitrage fund category has seen a lot of investor interest in the last few months, especially after a forgettable 2020. In fact, July of 2021 saw a net inflow of almost 15,000 crores, pushing up the assets under management for the arbitrage funds category over the hallowed 1 lakh crore mark. But having said this, it won't be incorrect to assume that most investors do not understand this category enough. So in this video, we shall look deeper into the subject. We shall understand what are arbitrage funds, how do they work, what are the risks and the returns, and of course, the right time to be investing in these funds. Let's begin. The word arbitrage refers to the practice of buying something in one place and selling it somewhere else where the price is higher. In doing so, the person conducting the arbitrage aims to make a profit from this transaction, and more importantly, he does so without changing any part of the item itself, which can be a stock, currency, commodity, or any other tradable item. In line with the broader concept, an arbitrage mutual fund looks to use the price difference between the cash and the futures market to generate returns. We'll get into more specifics of this in the next section, but from a structure perspective, arbitrage schemes keep at least 65% of their portfolio in equity and related instruments on which they take these arbitrage positions. In fact, most arbitrage schemes actually have a hybrid fund-like construct with a fairly decent portion of their corpus kept in high quality debt and in cash instruments as well. And this is done for two reasons. Firstly, money is kept as margin money, which is the collateral that needs to be kept with a bank in the form of FDs and term deposits. This comes to about 15 to 20%. And secondly, some money is kept in the liquid form, which is generally not more than 10%, and this is done to take care of any redemption pressures. So while the essence of the fund is equity, by composition, the arbitrage fund has a hybrid fund feeling to it, and perhaps that's why the SEBI classifies it under the hybrid fund category rather than the equity one. There are three things that categorize an arbitrage fund. One, there is a simultaneous buy and sell transaction. Two, it is the same security that is being transacted. And thirdly, the activity in question is happening in two different markets. Let's understand this with an example. Now, India has a cash market and it also has a futures market. And typically, the futures market operates at a premium to the cash one. So let's say the security we are dealing in is Reliance Industries, and one share of Reliance Industries is available at 2,000 rupees in the cash market and 2,040 rupees in the futures market. Since there needs to be a simultaneous buy and sell, we shall buy one share of Reliance in the cash market at 2,000 rupees at the beginning of the month and simultaneously sell it in the higher priced futures market at 2,040 rupees. Now, on the last day of F&O expiry, the cash market and the futures market generally converge. And that's when these funds close the loop by reversing their positions. That is, they sell in the cash market and they buy from the futures market. This method is also called the cash and carry arbitrage, and is amongst the most commonly used methods by arbitrage funds. Alright, now that the flow of the transactions is clear, let's extend our example over three possible scenarios. Scenario 1 is where the share price has gone up. So say Reliance goes up to 2,100. In that case, we have made 100 rupees of profit in the cash market. However, we have lost 60 rupees in the futures market, giving us a net profit of 40 rupees. Scenario 2 is where the price has fallen, so one share of Reliance is down to 1,900 rupees. In this case, we make a loss of 100 rupees in the cash market, but make a profit of 140 rupees in the futures market, which again gives us a net profit of 40 rupees. And scenario number 3 is where we assume that the share price remains where it was in the beginning of the month, that is at 2,000 rupees. In this case too, we see that the price difference in the cash and futures market gives us an advantage of 40 rupees. So whichever way you look at it, the arbitrage strategy gives us a fixed spread, which is 40 rupees in our illustration. And this is what the arbitrage desk at fund houses are trying to do. They try to lock in the profits irrespective of how the price moves. But having said this, waiting for the F&O expiry is not the only strategy that the arbitrage desk employs. For instance, in some cases, fund managers unwind their spot and futures positions even before the expiry if an opportunity presents itself for generating higher returns. Likewise, on the date of expiry, if the price differential for the subsequent month maturity still exists, in that case too, many fund managers look to roll over the futures position to capture the delta that's available on the table. While the cash and carry approach is the more commonly used arbitrage technique, there are a few more strategies that fund houses are known to apply in different capacities. One of these alternative approaches is the exchange arbitrage, which occurs when the price of a particular security is different across two stock exchanges. And when a situation like that happens, it requires the buying of a stock at the lower price exchange and selling it on the higher price exchange to book the available profits. Yet another technique is the index arbitrage, which looks to exploit the difference in the index value and the individual prices of its constituent stocks. For instance, the arbitrage desk might find that the Nifty 50 index is priced at a premium in the F&O market when compared to buying up the individual stocks at the spot market. This too is a form of arbitrage, as the fund management team looks for visible profits by taking very minimal risks. Arbitrage funds are perhaps the only category of mutual funds where volatility actually works to the investor's advantage. To get a better hang of this, we compared the movements of the Nifty 50 arbitrage index with the India VIX index. If you're hearing this term India VIX for the first time, then in a nutshell, it stands for the India Volatility Index, which is an index that measures the stock market's expectation of volatility, that is the Nifty 50's expected volatility over the next 30 days. The India VIX values and also the arbitrage index values are available on the NSE website, and here's what we found. Generally, and as expected, the higher the VIX, the better has been the performance of arbitrage funds. This has been the case in 2011, 2012, 2013, again in 2015, and there is that tendency again in 2021. So what happens when there is high volatility in the stock markets? For one, the price difference between a security's spot and futures, which is also called the spread, it tends to rise, which consequently is exploited by the arbitrage seeker. In fact, this opening of the spreads is what has been happening since the beginning of 2021, and as a consequence, we are seeing a lot more inflows in the arbitrage fund category. Now, while these opportunities stand out during volatile markets, these advantages do exist in a bull market as well, as the future prices tend to be higher than the spot market. More prominently, it's a bear market where it is common to see the future prices of many stocks trading at a discount to the spot price, which allows for far and few arbitrage opportunities. A most recent example of this is March of 2020, when we saw arbitrage spreads had narrowed dramatically from the typical 35 to 50 basis points range to just 10 or 15 basis points. This played havoc with most arbitrage funds, and consequently many fund houses suspended fresh flows into their arbitrage schemes during that period. So to put it compactly, go for arbitrage funds when the spreads are wide enough, and when these spreads narrow down or go negative, then one can consider unwinding their arbitrage positions. Like most mutual funds, the returns from arbitrage funds are not stable and depend on how much of a spread that is available. When volatility and therefore the spreads are high, arbitrage funds have historically offered as high as 8 to 9%. But when the spreads narrow, the returns from these funds go down to a 4 to 5% range. So if you are someone who believes in averages, a good returns expectation from arbitrage funds based on the historical data is about 6% plus minus 50 basis points. Now, arbitrage funds are often compared to short duration debt funds like a liquid fund or an ultra short term fund and even a money market fund. So we did our own comparison here by picking up the top ranked fund from the ET Money Fund report card in each of these comparable categories. The table here shows that at least from a performance perspective, an arbitrage fund is quite comparable to a liquid fund, and both these funds, that is the BNP Paribas Arbitrage Fund and the Quant Liquid Fund, have had the same annualized returns over the last 4 to 5 year period. But this is not really a same size comparison. After all, liquid funds have a lower standard deviation, which means they are less volatile than arbitrage funds. And secondly, it's important to consider taxes when comparing liquid and arbitrage funds. In fact, taxes are important, and that's because arbitrage funds are treated as equity funds for taxation purposes. This means the short-term capital gains are taxed at 15% and the long-term capital gains are taxed at 10%. So to put this together, A, it's wise not to use arbitrage funds as a replacement for liquid or ultra short-term bonds, as each fund category have their own pros and cons for different scenarios. And B, arbitrage funds do make a lot of sense for an 8 to 15 month parking of money, especially with the taxation advantages kicking in. Some dictionaries describe the term arbitrage as riskless profit, but arbitrage funds are none of that and weather quite a number of risks. For instance, there is the performance risk, and since the spot and future positions are marked to market on a daily basis, it's quite possible for you to have negative returns from an arbitrage fund in the very short term. The lack of arbitrage opportunities is another risk that these funds face, and it really doesn't help that there are only about 140 stocks which are qualified for any kind of arbitrage play. But having said this, we have seen in the course of this video that there are some points in time which are ripe for arbitrage opportunities, which does work to an investor's advantage. Plus, if we add the fact that there is a taxation benefit, arbitrage funds do come across as a good option for cautious investors who want to park their surplus money when there is a persistent fluctuation in the market. In fact, it's not just for the cautious investor, and we know a lot of active mutual fund investors who use arbitrage funds as a parking area for their money, and as and when buying opportunities open up in the stock markets, they diligently transfer money from their arbitrage funds to their equity funds. So come to think of it, an arbitrage fund has something for every type of investor, whether it's a cautious person or someone who's more aggressive, or even for a pragmatic investor who wants to keep an emergency fund. And with this, we come to the end of this presentation. If you learned something new today, then don't forget to press the like button and share this video with your friends. Do subscribe to the ET Money YouTube channel, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.